First, let's take a look at the gold futures price trend over time. The top panel of the chart shows us some really interesting price movements. From 2008 to 2011, we saw a massive bull market in gold prices. This was a significant uptrend, with gold peaking around 2011 at record highs. But after that, from 2011 to 2015, gold entered a prolonged bear market. Prices steadily declined during this period. Then, starting in 2016, gold began to recover. The uptrend became more pronounced from 2019 onwards, culminating in new all-time highs in 2025. Now let's talk about the Commitment of Traders (COT) report. This report breaks down the positions of different market participants, and it's a powerful tool for understanding what's driving price movements. First up, we have the commercials represented by the red line. These are the hedgers, gold producers and users, who trade to manage risk rather than speculate. In 2011, when gold prices peaked, the red line was at an extreme low, showing that commercials were holding heavy short positions. This might suggest temp market top is near. Fast forward to 2020, we saw the same pattern. Gold hit new highs and commercials again had substantial short positions, signaling another potential reversal. Now let's look at the large speculators, represented by the purple line. These are the big players, hedge funds and institutional traders, who trade for profit and often follow trends. During the major bull markets like 2008 to 2011 and 2019 to 2020, the purple line surged sharply. This shows that large speculators were driving the price rallies. But here's the catch. When the purple line reaches extreme peaks, it often coincides with overbought conditions. This can signal a potential reversal in the market. In 2012, the FSA accepted that the custodians, HSBC Bank USA NA for GLD and JPMorgan Chase Bank NA London branch for SLV, JPMorgan Chase & Company, is one of the custodians of the Spider Gold Trust, GLD, the world's largest gold-backed exchange-traded fund, ETF. Since December 6, 2022, this role involves storing a portion of the gold held by the ETF in its vaults, alongside HSBC, which had been the sole custodian since the fund's launch in 2004. The addition of JPMorgan as a custodian began on December 6, 2022, and marks a significant development for the fund and JPMorgan's bullion business, gold repatriation. Since 2017, several central banks have repatriated gold reserves from storage in New York, Federal Reserve, and London, Bank of England, as part of a broader trend of increasing control over their gold holdings. Below is a summary of notable repatriation efforts. Key examples of gold repatriation: Germany, Bundesbank, completed the transfer of 300 tons of gold from New York to Frankfurt in 2016, ahead of its 2020 schedule. By the end of 2016, 47.9% of Germany's gold reserves were stored domestically in Frankfurt, with the remainder kept in New York, 36.6%, London, 12.8%, and Paris, 2.7%. The Paris holdings were also fully repatriated by 2017. Turkey. In 2018, Turkey repatriated 220 tons of gold from the Federal Reserve in New York to its domestic vaults. This move was part of a broader strategy to reduce reliance on foreign storage amid geopolitical and economic concerns. Hungary. In 2018, Hungary repatriated its entire gold reserves, 31.5 tons, from London to Budapest. This decision was motivated by economic security and sovereignty considerations. Poland. In 2019, Poland repatriated approximately 100 tons of gold from the Bank of England to its domestic vaults in Warsaw. This was part of a broader effort to increase its gold reserves, which have grown significantly in recent years. Netherlands. The Dutch central bank announced plans to relocate part of its gold reserves stored in New York and other locations to a new facility near Amsterdam for better security and accessibility. Venezuela has made multiple attempts to repatriate its gold reserves stored abroad, particularly from the Bank of England, but faced legal and political challenges due to international sanctions. Elon Musk is now gearing up to conduct an in-person audit of the United States gold reserves at Fort Knox, on behalf of the Department of Government Efficiency, or DOGE. Musk announced his intentions on Monday afternoon through a pair of posts on his X platform, implying that he doubts whether the $425 billion in bullion is really there. JPMorgan is one of the official custodians of GLD and SLV. Gold and silver are the metals that have heavily withdrawn from the LBMA. JPMorgan is a major custodian for both GLD, gold, and SLV, silver, which are large exchange-traded funds. These funds have seen significant physical deliveries recently, contributing to the metal flows from London to New York. This aligns with increased demand for physical settlement on COMEX. Market arbitrage pricing disparities between New York, COMEX, and London have created profitable arbitrage opportunities, encouraging the movement of metals to COMEX for delivery. For instance, gold futures in New York have traded at premiums as high as $50 per ounce over London spot prices. Geopolitical factors and Basel III, geopolitical tensions and regulatory changes like Basel III, which elevate gold's status as a Tier 1 asset, are driving central banks and institutions to prioritize physical gold holdings over paper claims. This has intensified demand for physical metal in the US, where COMEX inventories have surged. LBMA's structural issues. The LBMA operates as an over-the-counter market with limited transparency and reliance on member inventories. Persistent outflows could reflect deeper liquidity issues or a shift in market preferences toward more transparent systems like COMEX. Conclusion. While US tariffs may contribute to metal flows, they are likely a secondary factor. The larger drivers appear to be arbitrage opportunities, ETF-related deliveries with JPMorgan playing a key role, regulatory shifts favoring physical gold, and structural challenges within the LBMA system. This broader context better explains the scale of outflows from London to New York for both gold and silver. However, the concern in LBMA's physical gold delivery exposes the weakness of LBMA's role. Overtraded paper gold is a concern in the future,